the labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession, and you see inflation start to come down. And I think that's very plausible.
That was Federal Reserve Chairman Chair Powell yesterday at the Brookings Institution on his continued belief that there is a path to a soft, or at least a softish landing for the U.S. economy. Powell also making headlines over remarks on the Fed being prepared to slow the pace of rate hikes in December. Joining us now for how the market is shaking up following the latest Fed insights is Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Megan, thanks for being here. And you recently released your holiday wish list for 2023, which sounds a little bit like Powell's wish list as well, by the way.
Exactly.
And where you're talking about that, it would be great to have 4 quarters of GDP growth in 2023. It would be great, wouldn't it? But what do you think the likelihood is of that happening?
Obviously, that's a wish list. So yes. I think that the first half of the year is going to be the most challenging for the economy. I think the second half might look a little bit brighter, but the first half is primarily going to be challenged from the consumer. That's been our biggest concern for some time. The consumer's been resilient. That this is because of the stimulus that had been given after the pandemic and the ongoing stimulus that we've seen. But what we've seen in recent months is they're winding down savings. The savings rate is the lowest we've seen since 2005, and they're using credit card debt to fund this savings. So we're seeing credit card debt growing at a double-digit annual pace. This is not sustainable coming into 2023, and we'll see some cooling from the consumer standpoint. We don't want to see consumers get too over-leveraged here in this economic environment.
Inflation is typically it's the stickiest in some of the either services areas and even in some of the necessities as well that consumers are spending on. How resilient do you expect consumers to be able to be, and for how long, considering the elevated levels that they're having to incur expenses on there?
I think after the holiday season going into 2023, when consumers reassess their balance sheet, that they will start selling. So I think it's more going to be a first and second quarter. And remember, the consumer makes up the majority of GDP. So right now, the estimates for GDP in the first and second quarter are basically flat to negative. I think that's likely because I think the consumer will be the big drag on GDP. The other thing is, if you look at things like manufacturing is also slowing pretty quickly. We'll get some data out here shortly at 10 a.m. on the ISM report, but we're seeing manufacturing pull back as well. All of these things on top of what we've seen this year with the kind of deterioration in the housing market as well.
Yeah, we saw that, by the way, in the ADP report yesterday, right? A big drop in manufacturing jobs. That definitely caught my attention. We'll see if that's confirmed by the jobs report on Friday. So all of this said, Megan, what do you do from an investment perspective going into next year? It sounds, you're sounding defensive to me, but I don't know if that's what you're doing in your portfolios.
So I think cautiously defensive is a better way to state it, because we're not talking about a recession that's going to be a prolonged recession like a 2007, 2009 period. We've already seen recession-like conditions in the U.S. this whole calendar year. And a lot of, if you look at consumer confidence, it's basically saying that we're in a recession. So I don't think that we're going to be for this prolonged period of economic contraction. I think that the second half of next year will look better. So we don't want to be too defensive, because some areas of the equity market are already pricing in and reflecting this downside that we expect. So we are sticking with some of those areas that we think are already reflecting the downside, but we are looking to maybe increase some cash, make some minor tweaks to our asset allocation, look at some of these areas that have run up quite a bit since the October lows, and look at those and see if they stand to decline some more in the first half of 2023. So those are the areas we're looking to maybe trim up on. Think about your mega cap, your tech, your growth areas. We still think there's some room there for downside in the first half of next year in those areas.
And so on the rebound, would they be the names that lead the market higher?
When you come out of what we think may be a challenging first half of next year, it depends on what the interest rate environment and how much we see of a decline in these equities, these sectors of the equity market that haven't seen a real PE contraction or an earnings, realization. So I do think that depending on how far and fast that they drop, they could be some of the areas. So there may be opportunity to re-enter those parts of the market. But we are still looking at an interest rate environment that is nothing like we've seen in the past decade. So we have to keep that in mind. We're not going to see the Fed drop down to 0% interest rates at any time soon. So I think that you have to price in, even going past the second half of next year, what that interest rate environment will look like and how that will be different.
Megan Horneman, who is the Verdence Capital Advisors Chief Investment Officer. Thanks so much for taking the time here with us this morning. Appreciate it.